Good evening, everyone. This is Brian Herbert with Prostatis Financial Advisors Group, and this is our third quarter economic update. Today is October 1st. I know I normally do this on the first Tuesday of the month, but I am going to be out of town that week, so we are doing our first Tuesday on a Wednesday this quarter. So I will go ahead and get started here. Obviously, this is informational purposes, not intended to represent any investment or specific investment advice. All this is information that I go out and I gather based upon the economic indicators and the signals and the factors that we look at when it comes to making investment decisions, strategy decisions for the portfolios here at Prostatis and for the financial planning aspect. I'm going to skip past that slide because it doesn't apply anymore since they passed the Tax Cut and Jobs Act. One thing to note really quickly, the IRS just finalized its guidance when it comes to some law that was enacted many years ago. So basically, starting in 2026, anyone who's over age 50 and is considered to be a high earner, and a high earner means anyone earning more than $145,000 per year as earned income, pre-tax catch-up will no longer be allowed. So the extra money you're allowed to put in because you're over the age 50 is no longer allowed to be pre-tax. All those cash-up contributions now have to go into the Roth portion of your 401k. Roth 401ks, I think the study that I read is offered for about 90% of 401k plans out there. But most importantly, if you do not have a Roth 401k available to you and you are contributing that catch-up contribution to your 401k, it will no longer be allowed after that point. So if that is the case for you, you should go to your employer and tell them that, hey, the legislation has been passed for us to have the Roth 401k. Let's go ahead and get it going so I don't lose the extra money that I'm putting into my 401k every year to kind of help me out for retirement. All right. Now, this next part, really, this is kind of the fixed equity and fixed market commentary. It's not a crystal ball, like I said, really just the factors that we at Prostatis are considering when we're making our market decisions, our portfolio decisions, and our financial planning decisions. This really just came up last night. When I originally did my slideshow, I was kind of planning for, trying to figure out what's going to happen. But, the government is obviously in a shutdown right now. Over the past 50 years, the average S&P 500 return during a government shutdown has seen a decline of about 1.6%. So it is not the end of the world when it comes to the stock market, when it comes to government shutdowns. The worst market decline we had seen during a government shutdown was in 1979 when the S&P 500 was down more than 6%. And the longest shutdown in history was when Trump was president, his first time around, lasted from December 22nd all the way through January 25th of the following year. So a little bit more than a month is how long it lasted. During that time period, the S&P 500 rose more than 10%. So history really doesn't tell us what the stock market is going to do in situations like this. Normally what happens is institutional individual investors have looked past these budget-related disruptions and, political showboating or political grandstanding from that perspective and really prioritized corporate earnings, broader economic trends, and other economic factors. There's not, probably not going to worry a lot about this shutdown either. the AI boom that we have been seeing, a lot of corporate earnings, resilient corporate earnings that we have seen, and anticipation of interest rate cuts really have lifted stocks to kind of record highs in more recent months. Shutdowns, government shutdowns don't really change much for corporate America. So there's not a lot to be concerned about. Really what we expect is that there will just be extra volatility in the markets, a little bit more than normal, than what we normally see, but I don't foresee there being any drastic changes that we have to take in the portfolio based on this government shutdown. But time will tell. We'll see how long this shutdown lasts, how long the political standoff lasts between the Republicans and the Democrats from that perspective. But time will really tell. But right now, like I said, there's not really much to worry about, we don't believe. We think that the market will be resilient, really focusing on potential interest rate cuts. That being said, all of the data that the Fed relies on, the reports that the Fed relies on to determine whether or not they make their interest rate cuts will be delayed, because those reports are generated by government agencies that are now shut down. So, it may delay the interest rate cuts that would have otherwise happened sooner, but really that's kind of what we're focusing on. Speaking of interest rate cuts, really the housing market has really yet to regain the equilibrium following COVID-19. We had a mini boom in the housing markets. Mortgage rates really skyrocketed at that time period because interest rates were going up. Right now we're seeing still pretty high home prices in the U.S., which is kind of putting downward pressure on homeownership rate, the homeownership rate has really fallen to multi-year lows. What we've seen here in our chart here is we had this really high spike of home ownership in COVID. Right after COVID, people wanted to get out of their situations, and it's kind of fallen off. Really, we don't foresee a lot that this trend is going to have any upward movement until mortgage rates start to come down in the future, home prices start to come down. But really, we're reliant upon the Federal Reserve to lower the interest rate. That'll trickle down to mortgage rates, which will lower that. And really what we need to have is a fairly strong labor market. No huge surprise in unemployment claims, no huge surprise in continuing unemployment change. So that way the Federal Reserve makes their decision to continue to cut interest rates. Housing affordability, the National Association of Realtors, their housing affordability index really measures whether a typical family has sufficient income to qualify for a mortgage. Really what we've seen is that affordability has kind of fallen off here. Lower on this means that there's not as many people, typical families, that can afford a mortgage because of how high home prices still are. You can see right here, COVID, I know this kind of is counterintuitive to what you see in the chart, but COVID drove the prices of homes up. So the affordability of the houses really went down when it comes to that. The other affordability component is interest rates, mortgage rates. This chart really shows we had a peak in late 2023 of mortgage rates right around 8%. Now we're hovering right around 6.6%. In all likelihood, the Federal Reserve was going to start cutting, it cut the interest rate a little bit. They were going to continue doing so. As I said, it will be delayed a little bit because of the government shutdown. The longer the government shutdown lasts, the longer that delay will be there before rates come down. so the assumption is that mortgage rates will continue to come down. Bond market investors, really truly control mortgage rates. It's not truly the Fed that controls interest rates, but mortgage rates really do kind of correlate with the 10-year Treasury bond rate. The Fed really controls the Fed funds rate, which is the short-term interest rate that banks charge each other for loans. Longer-term interest rates are really affected more by overall investors' expectation about inflation and their expectations about economic growth. Really what we're waiting on is the Fed to kind of continue to cut interest rates, which will, lower expectations about inflation for overall investors. Lower interest rates, is going to lead to more economic growth, which will then in turn lead to mortgage rates starting to come down. I am getting a lot of questions recently about whether or not it makes sense for me to, take money out of my 401k or take money out of the bank and pay off my mortgage. I have $80,000, $100,000, $150,000 on my mortgage. Should I just pay it off? Right now, if you have a mortgage rate that's below 4%, it doesn't, in most cases, it doesn't make sense to just go ahead and pay off that mortgage, simply because if you have the money in a high yield savings account, any of the high yield online accounts like Ally Bank or Discover Bank or Western Alliance or Capital One 360, any of those, as long as the money is earning more, those are normally around 4.1%. As long as the money there is earning more than your mortgage rate, your interest rate, leave the money in there, let that money continue to earn for you. Plus, if you're going to be cashing money out of a 401k or out of an IRA, you're going to take probably 30 to 40% hit on that money to take a large chunk out to pay off the mortgage. So it is a conversation that we should have if it's something that you're considering. But I do, as long as the Fed holds course with what they've talked about doing, where they're going to lower interest rates, I do believe we're going to start to see mortgage rates start to come down in the next 4 to 6 months. That being said, inflation is still slightly above where the Fed wants it to be. So, we're not going to see a drastic rate cut when it comes down to it. Inflation is elevated. Our deficits continue to rise. That's kind of, evidenced by the government shutdown and they're arguing over budget. The next Fed cut, we expect, a moderate move down. Long-term yields are still likely to stay elevated if we have, this kind of higher inflationary measure here. Unless we start to see really inflation start to come down, we're going to see longer term yields still kind of remain elevated. The target for the Fed, is 2%. We've been above 2% inflation. You can see since pretty much, about 4 years, right here in the middle of 2020 when inflation really skyrocketed. It skyrocketed, but it's fallen steeply from the peak that we saw during the pandemic, but has been stuck in this 2.5% to 3% range for over a year. It has been edging a little bit higher here, given what we see with the tariffs. And I think it's going to push inflation a little bit higher into 2026. The Fed really wants to base its policy on low inflation and full unemployment. We still have, like I said, a little bit higher, 2.5%, 3% on our inflationary measure, which is higher than 2%. Unemployment rate is right around 4.3%. So it doesn't tell us that we're going to have a massive rate cut. Probably, another 1/4 point, maybe 1/2 point, whenever they get announced to it. Unemployment, tends to be a little bit elevated because most of the recent data has been suggesting that there's a hiring slowdown and layoffs starting to pick up, and that really could be due to some of the tariffs. I think that we're probably going to see 1, maybe 2 rate cuts before the end of the year, but I really think we have a chance of 1 unless we see inflation start to cut down and unemployment start to come down a little bit as well there. Right now, the spread between long-term rates and short-term rates, this is what we're seeing here. The fiscal policy, has been keeping long-term yields from falling much. So there's not a big, a drastic difference between yields between a 5-year treasury and a 30-year treasury. Typically, if you're going to put your money away for 30 years, you want to earn a lot more interest if you bought a 30-year treasury, a lot more money in interest than if you were going to put it away for 5 years. Right now, it's only 120 basis points, which is about 1.2%, which is still, as wide as it has been in the past 5 years, but, still well below where we were during 2015, 2017. Investors right now are demanding, high yield long-term securities, really to try to compensate for inflation. We want to combat inflation. We want to have our money, safe money, earning more interest, and that's kind of what we're starting to see in the overall market. We are starting to see a divergence in our inflation internationally. Right here we have the blue line is the Eurozone, where inflation is kind of started to fall off in the last year. The U.S., we've seen it start to fall off as well, but now we're starting to tick up. That's our little yellow line here. Inflation in Canada started to tick up a lot sooner, and then inflation in the United Kingdom also has gone up. Central banks are viewing this inflation as temporary. The increase in prices is really, due to the tariffs, which is then leading to them having to raise wage. The tariffs is really leading to them having to start to raise prices. Developed countries' central banks started raising their interest rates in 2022, as we can see here, to start to combat, inflation. Everything peaked at different times. You can see that the time at which the UK peaked is different than when the US prices peaked. It's different than when the Eurozone peaked. It's different than when Canada peaked. But really, overall, the divergence. The UK inflation is increasing due to higher minimum wage, higher energy bills. Canada's inflation is rising because of retaliation tariffs in response to the U.S. The U.S. is a little bit trickier because we got a lot going on, and the Eurozone is really still seeing inflation go lower. And I talked last quarter about, we really started to see a surprise in how well the European markets are doing. So we continue to have some exposure in those international markets. We're using, international ETFs, but we're also using that one ETF, the THIR ETF, which is kind of a sector rotation type of fund of funds where we can move investments in and out of that fund without causing a lot of overall taxable consequences. And that's where some of the exposure to those international markets really is coming from. Excuse me. If we just look at core inflation in its isolation, doesn't tell us the full story, kind of what's going on, comparing, the Eurozone and how their economy is doing and how their central bank is doing, comparing it to England and comparing it to Canada and to the U.S. Central bank in Canada and in the Eurozone have pretty much reversed about 50% of their rate hikes. As you can see, the green line, they peaked up right around 5 and 4.5. Now the Eurozone or Canada is right around 2.5, and the Eurozone is close to 2%. So they're, almost half of their interest rate has come down about 50% of what they raised it to. In the United Kingdom, inflation, as I just showed you, continues to remain high. It's ticking back up. They have kept their rate pretty high. It's come down a little bit, and then finally, the Federal Reserve has pretty much kept its rate steady until just recently when it announced its one rate cut. I think that we should continue to see rate cuts by pretty much all the major central banks, with the exception of the Japan, because they're kind of in a different area all by themselves. What we're going to see out of Japan, which is another major economic central bank, we anticipate them, having a increase in their interest rate over the next 6 to 8 months. The potential of economic slowdown in the United States has really kind of prompted the stock market to start to price in decent sized rate cuts. And what we're seeing here, the blue column is, it's the estimated change in the rate through the end of the year, 12/25, and then for the first half of next year, 12/6. Canada, their economy actually contracted in the second quarter, so they're not going to see that big. Their markets are not really pricing in that large of a rate cut. Stock markets kind of expect England to continue cutting their rate, but not anytime soon. As we can see, as that blue line has, it's substantially shorter than the green line, which is expecting the rate cut to happen sometime next year. Excuse me. But increasing minimum wage in the UK has really led to tightening of their labor market. Jobs are not as available. So that really would probably hamper kind of what they're doing. The European Central Bank is probably near the end of their rate cut, since they are pretty much right around where they want to be, right around 2%. Japan, as I said, they kind of stand alone. The stock market, the markets really anticipate Japan to hike interest rates. They just came, they're finally coming out of their 30 years of deflation. Their first rate hike happened in March of 2024. That was the first interest rate hike that they had seen in 17 years. Really what this means is, in isolation, more rate cuts for the United States relative to the rest of the world really starts to weaken the dollar. But if we see rate cuts start to happen in the other central banks, it'll kind of give us a little bit of a strengthening of the dollar against what they're doing. But right now, really the signs that we're looking at really kind of pointing to, we shouldn't have that big of a disruption in the United States, given the economic growth that we're seeing, the AI boom that we're seeing in our markets. But it really could kind of see boosted returns because of what's been going on internationally with the international central banks, the major central banks in the international markets. We should see fairly decent returns out of international positions, Eurozone, and areas similar to that, whether we're just going into the EU as a whole or going into specific countries over there. Lastly, the last thing I want to talk about, I talked about this last time as well. Scams really continue to be present. I think I got 7 different scam emails today alone. If you're getting emails with links in it to invoices or settlements, and you're not expecting it, you don't realize the sender, really don't click on those links. It's going to take you to scam websites. The scammers just get more and more advanced. You know, you'll get them from, I had one from the IRS the other day that came through for a client of mine. It wasn't the IRS. These governmental agencies are not going to call you out of the blue. They're not going to text you. They're not going to email you. You will get a letter in the mail from the IRS if you owe them something. You get a letter in the mail from any agency if something is going on. You know, I actually received one, a phishing email, a scam email, that made it look like it was directly from Charles Schwab. It had Charles Schwab's logo. It used all the correct fonts. It had the white and blue lettering in their email that Schwab uses in their email communication. And it really was, you know, I don't recall the nature of what it was trying to do, but it came to my personal email, since I do have my own personal Schwab accounts, and I'm looking at it, and it was different. It looked slightly different than the way it normally looked. And when I went to hover over the email, it wasn't from Charles Schwab. It was from, you know, Tom Smith at some really, really long email address. So, you know, just be mindful of the scams that are out there. Pay attention to the links you're clicking on. Don't click on anything you don't know. Don't respond to text messages. Obviously, one of the big things here in Maryland has been the Easy Pass scam. You're getting texts about your Easy Pass tolls being overdue, and it's coming from an international number because it has a plus 33 or plus 62 country code on there. Okay. Any questions? I encourage anyone to give us a call, 410-863-1040, 410-863-1040. Talk to myself, Faisal, Andrew, Lawrence, Catherine, Mike, you know, any one of our advisors or our service team if you have any questions. We are coming to the end of the year, so we will be doing our fall reviews in October and November. I know the team is working diligently on making sure we get all of our RMDs done in October. Same thing with the Roth conversions. So if we get to towards the end of October and you haven't heard from our team in regards to your RMD, or you haven't heard from our team in regards to Roth conversions, please feel free to reach out to us, 410-863-1040. And that is what I have for everyone tonight. I hope everyone has a wonderful evening and a great start to October here. So everyone have a great night, and thank you for listening.